you have Chicken Genius now saying that it's this simple. It's a question of the money supply. Fed puts money, markets go up. Fed tightens money, markets go down. And then on top of that, I hope this ties in well. But then you have people like Tom Nash back in October, November, saying that they're buying the Palantir dip at $21. The $21 at Palantir was a dip. So I don't know if these are all separate, but they all sort of tie in together as one of people saying that they know what's going to happen. So are they in any position to make these claims? Like, why are they making these claims with such confidence? I'm talking about like Tom Nash at 21 and also Chicken Genius now saying, oh, don't buy, it's going to be a disaster. There's another 15% to go. And Peru says the same thing.
I believe there is a fundamental problem in when everyone is so sure and starts pushing the idea that he must be right. Because as we said, being right on the business is already extremely difficult. It requires a lot of years of experience and a lot of months or years to fully understand the business. So that is already difficult. What you implicitly say when you say, okay, this is the bottom or this is the top, you implicitly assume that you know how people will behave. Because as we said, in the short term, it's only a matter of perception. While I appreciate strong opinions, I strongly disagree when I see these opinions like Chicken Genius saying, don't buy the dip, because he was one of those saying buy the dip last year. And he exposes himself to a lot of risk, reputational risk in making these things. And since he is very followed, I believe there is a sort of responsibility if not pushing people making certain decisions. It's good to present your opinion, but saying don't buy the dip sounds hypocritical.
Well, he would say it's not hypocritical. He would say the facts change, so my opinion changes. And he said I guess he would say if you can't change with the facts, well then it's your problem.
Well, it is true. Great investors change their mind as facts change. Here, the fact that the Fed sooner or later would have raised interest is no surprise. True, we didn't expect maybe this much reaction, but I think it's very pretentious to say don't buy the dip because you assume that you are right. And to me, it seems many creators just say what they know the audience would want to say, rather than being completely detached and assuming a position like, I have an idea where it will go, but this is my reasoning for these reasons. While when you say, don't buy the dip, you assume you will be right. And you can also be right, but for the wrong reasons, probably that are impossible to foresee before. For instance, right now the market is so skewed onto the negative feelings that if something good happens, and we can't know that something good will happen, but let's say the new data from the inflation comes lower. Hard to say, but could be. Or let's say Russia and Ukraine reach an agreement. Immediately, boom, that changes everything. And if you don't buy the dip because Chicken Genius tells you so, then maybe you end up buying the companies you wanted for a much higher prices just because you didn't buy the dip because everyone else is here waiting for something good to happen just to jump in.
Yeah, so but let me just jump in there. Go ahead.
My approach is focus on what we can know and don't overpay for the companies we want.
Yeah.
If these two conditions are met,
Yeah.
we know that very hardly we can go and make big mistakes. That is the principle of sound investment. Because if you start thinking, okay, now I don't buy because the Fed is shrinking the balance sheet. And fun fact, from 1978 to 1980s, the Fed rates went from 10% to 18%. Yet the market performed well. So it's not that if the Fed rises the interest rates, then the market can't perform. Because as we said, the key driver of performance of the S&P 500 is the growth and the expansion of a multiple on that growth. And if the businesses grow much more than the inflation rate, that is still a great. And being invested in equity is in reality the only way that you can incorporate the inflation into a benefit, because if inflation rises and great companies are able to transfer the spike in cost both to customers and to suppliers, that translates into higher earnings. Higher earnings translate into higher value. So being invested in outstanding companies that are able to survive and strive is in reality the only inflation hedge out there. Much better than gold, inflation-linked bond, and other things, or Bitcoin. But for sure, in the short term, there can be multiple compressions because people are scared they sell. Because right now, many businesses are damaged in terms of stock price, even if in reality they benefit from inflation. We always speak about Palantir being designed for bad times, inflation, war, supply chain issues. Those are all bad times that give a boost to Palantir business, but the stock price declining implicitly says this company, rather than expanding the growth, will compress the earnings. And if that will come not true, there will be a revaluation of the multiples.